Hi, my name's Joe Achaturo. I'm a certified public accountant, and I'm going to teach you everything you need to know about doing your own taxes. So let's get started. All right, today's class is going to be about adjustments for your health savings account deduction. This is otherwise known as your HSA. Contribution limits, right? How much can you contribute to your HSA? Well, these are the numbers. For an individual in 2018, the max number you could contribute is $3,450. If you are a family in 2018, your max number was $6,900. Now, these go up every year pretty much. So in 2019, next year, the contribution max will be $3,500, and the family max, if you have a family of any size, will be $7,000. All right. The reason I'm going to put this slide first is because I want you to understand the benefits, and I want to entice you to watch the rest of the video. What could this be worth to you in the future? First, let's go over what your options are now. Your options now are to pay regular health insurance into a plan where if you don't use the money or you don't use the doctor, your money basically disappears, right? When you get older, if you get sick and you have a multi-year illness due to and you're forced to stop working and take an early retirement, chances are all that money you paid into your health insurance is going to go to waste, right? And you're going to have to switch over to Medicare, and that in itself is pretty much a nightmare. Third, when you retire and you're on Medicare, you're subject to whatever they approve for your services. And this is a healthy option to keep you economically in control of your own health care for the rest of your life, you and your spouse. So let's take a look. What could it be worth to you in your future? If you were going to take, let me turn this on to presentation mode. If you were going to take $3,450, you see what I did there? I took what the amount is you're going to contribute yearly as an individual. We're going to assume a growth rate of 8%. And we're going to assume that, let's say you started working at 23 years old, right? Well, 10 years from then, you'll be 33. By 38, you'll have $112,000 in that account, assuming an 8% growth rate. Because now you can invest this money. Tax-free. It accumulates tax-free, comes out tax-free as long as you use it for health care. Right? But in 30 years, by the time you're 50-something years old, you can stop contributing altogether. Now, if you want to contribute until you're about 60, 65 years old, you could have over $1 million in this account if you manage to be a healthy individual your entire life. That's insane. That's insane. You want state-of-the-art treatments that aren't yet covered by insurance? You can afford it. You want stem cell regeneration for your knees and ligaments? You can afford it. You're not stuck listening to Medicare tell you the only thing we're going to cover is complete knee replacement, which is going to debilitate you for 6 months to a year and possibly not even work. Right? You have the option at this point, if you use a health savings account, to be in control of your destiny when it comes to your own health care. And you will never rely on the government. With that said, let's move on to actual tax rules. I think I've pretty much should have gotten your attention with the benefits. All right, so what's a health savings account, right? What is one? If you don't already have one, you can buy one on the exchange. It is a tax-exempt trust or custodial account you set up with So you have to be along with. So with a qualified HSA trustee to pay or reimburse certain medical expenses you incur. What's that mean? I'm going to break it. It's easy, right? It's right in the name. A health savings account is a savings account for your health care. That's all it is. So what has to happen is you have to buy a high deductible health insurance plan. And I'll go over the limits of that later. And what you do is that high deductible plan is going to be cheap compared to what you would normally buy for health insurance. Right? When you buy that, you simultaneously are going to contribute your money to your own health savings account. This money that goes into this account can be invested in very safe investments. You can put it in stocks and bonds. You can pretty much put any investment you want and watch this money grow over time. The trustee does not have to be the health insurance company that you use, right? So I can choose to use Bank of America. I can choose to use Citibank as my trustee for my HSA, while at the same time buying a high deductible healthcare plan from Cigna. Right? They don't have to be the same company. And this money stays with you, right? The money you put in your health savings account stays with you. And here are the benefits, right? It's a personal savings account for your healthcare expenses. The deductions are pre-tax, so they come out before you pay federal taxes. The account grows tax-free through investments and through your contributions every year. And the account follows you wherever you go. The biggest benefit is what happens if you become unemployed? Well, normally you become unemployed, you're going to have some financial troubles. Well, 10 years into this plan, you're going to have enough money saved aside, typically, if you max it out every year, where you're not going to have to really worry about your healthcare costs while you're unemployed, right? There will be money in that account for you to go to the doctor and take care of stuff when you need it the most, right? With normal health insurance, when you need it the most, it's really not going to be there, right? Because you're not going to have the money to pay for it after you've been fired. When can I contribute? So the contribution period is January through December of that tax year, plus all the way until April of the next tax year. So your due date of filing your tax returns of April 17th is the last day you can contribute to your HSA plan for the previous year. And here I outlined it for you, right? If the tax year is 2017, you can contribute from 2017 of January all the way till April 17th of 2018. How does your HSA get reported to you? First off, if you're an employee and the company you work for provides you with your insurance, your health insurance, your HSA amounts will be deducted from your W-2. So let's say I make $100,000. What goes into my HSA for the year is $7,000. Instead of my gross income showing $100,000, my gross income will show $93,000. See how that works? So you wouldn't do anything really. You will be receiving, in the end, a 1099 SA to show the distributions, and a 5498 to show contributions. In tax software that you use, you're usually going to take these two forms and simply plug the numbers in, right? And make sure, because sometimes you know what? Off the top of my head, I don't recall, but I don't recall them showing qualified distributions. It's a number you have to put in yourself, which is kind of silly, but I believe you put that number in yourself. Make sure you put that number in. You put in the qualified expenses, right? If you don't, you're going to have a tax on your tax return for distributions without qualified medical expenses. So make sure you put the actual amount, which is typically, if you use your HSA and you use like a debit card, this is the easiest way to do it. Use that debit card every time you go to your doctor, every time you go to your specialist, every time you get a prescription drug, every time you get an over-the-counter drug with a prescription. Make sure you just use the debit card. If you use the debit card, then every amount you take out is going to be a qualified expense. Don't take money out of the ATM and pay for stuff cash. Right? Then it gets hairy. Right? Use it for direct pay. This way it can be traced back. Keep the receipts every year. Okay, in case you get audited. So how do we report it? And you would report that stuff on form 8889, right? If you pay for your own health insurance out of pocket, right? You're going to claim the contributions made as an adjustment on your tax return using, again, form 8889. That's going to flow to Schedule 1 and then to Schedule and then to the front of your 1040. And you may not receive a 1099 SA, right? You may have put money into your health savings account, but maybe you didn't go to the doctor last year, in which case there'd be no distributions. Maybe you didn't get sick last year. There would be no distributions. All right? In which case you'd only get a 5498. So that's how it's reported. What do we use Form 8889 for? Let's take a look at Form 8889. I'm going to go over it really fast. Form 8889 is going to be for contributions and distributions, right? Contributions, Part 1. Distributions, Part 2. Basically, we're going to fill out the distributions. As long as the distributions equal the amount of your medical expenses that are qualified as medical expenses, you pay no taxes for that tax year. If your distributions exceed you pay taxes. Exceed your medical expenses, you pay taxes. What are the qualifications for a high deductible plan? Let's make sure I didn't miss anything. Yeah. I mean, I went over what happens, right? Form 8889, there's 3 steps. Form 8889, everything is going to total up on Form 8889. Move over to Schedule 1. Get added or subtracted to your other Schedule 1 items. From there, you're going to move Schedule 1, bottom of the page totals, and net them against line 36. Line 36 of Schedule 1 gets netted and subtracted from line 6 on your 1040. And then the net result goes on line 7 of the 1040. Qualifications. All right. What do you need to be qualified for a health savings account? First, you need to be covered under a high deductible health care plan. This is an insurance coverage with a high deductible. All right. Again, you're not going to need to search far and wide for this. These plans are available on your health insurance exchanges, either through your state or through the federal government if you don't have an employer that covers you. If you do have an employer that covers you, usually one of the options are going to be an HSA. And if your employer doesn't have one that does cover you, ask them to get it. You cannot have any other health insurance coverage except what is listed in sections A through F, right? So you cannot have any other health insurance coverage except the following: insurance for liabilities incurred under workers' comp, insurance for tort liabilities. You can have insurance for liabilities related to property, right? You can have insurance for accidents, disability. You can have dental, vision, and long-term care insurance. This is important, and I'll go over this in a second. Insurance for specific diseases or illnesses. You can have that, right? Insurance covering a fixed amount per day of hospitalization. Any fixed amount, right? So any insurance covering any specific fixed amount for a hospital visit is covered. Prescription drug plans, riders, right, for prescription drugs. Only once you've reached the minimum deductible. So your high deductible health insurance plan, out of pocket, you would need to first pay for the deductible with your HSA account for your prescription drugs. Then what you would get is your rider would kick in. Well, if it does that, then yes, this counts. A limited purpose FSA. So if you have an employer that gives you a plan that's available for your health savings account, they're usually going to also offer a limited purpose FSA, which is a flexible spending account. This flexible spending account is going to be for dental, eye, and preventative care usually. The benefits are the same as a health savings account, but they're two segregated accounts, right? So your FSA is going to be one account in which it's a use it or lose it plan. You would put in a specific dollar amount every year. If you get a deduction for putting money in that account. If you don't use that FSA for your dental and eye and preventative care, if you don't use all the money in that account, then at the end of the year, you lose that money. The health insurance company gets to keep this. Now, the fact that this plan exists is obscene to me. You need to write your congressman about this, because this is a gross misuse of your money, in which I guarantee health insurance companies make millions and millions of extra dollars by you putting money into your FSA but not actually using it. Personally, I think it should be against the law to have any sort of plan where you could put money away for your health care, and then the insurance company gets to keep it just because you didn't incur all the expenses you thought you were going to incur for that year. It's gross. There's so many things that are wrong with this. But either way, what we typically do in my household is we know in advance what our dental is going to be, what our eye care is going to be. And so what we do is we put that amount for our FSA so we don't have to use that as a separate deduction to come out of our HSA account. So what we do is we put together that limited purpose. We use that for dental and eye, because I find, and through what we've done in the past, that your dental and eye care insurance is typically not worth buying. Right? It usually covers you to the amount that you actually end up, whatever the amount typically ends up being for that particular procedure. You usually don't get a benefit out of it, unless it's something above and beyond your normal everyday care, right? And how often do you need an emergency root canal? If you brush your teeth every day, pretty much never, right? So these are things that can be avoided. Next, what you need to qualify. You are not already enrolled in Medicare. So the second you become enrolled in Medicare, you are no longer qualified for an HSA to put any more money into it, right? You cannot be claimed as a dependent on someone else's tax return. You can meet the requirements even if your spouse has a non-high deductible plan. So you could be married. You're both, let's make it simple. You both work for two different companies. Your spouse has a regular insurance plan as a single individual, not a family plan. And you have a single individual high deductible plan, right? You're still qualified. You can do that. There are certain medical services and that'll be administered under the Secretary of Veterans Affairs and Service connected to disabilities. You may still be eligible if you have that on it. Special rules. There's something called the last month rule, and it states if you're eligible, you're individual on the first day of the last month of the tax year, let's call that December 1st for 99.999% of you, you are considered eligible for the entire year, and you can contribute the full year worth of contributions for that policy. Okay? All the way up to, you're not even in the final month, all the way up to April 17th of the following tax year. Or whenever it is you file your tax return. The testing period. This is going to be, this is going to have to do with that last month rule. If contributions were made to your HSA based on being eligible for the entire year under the last month rule, you must remain eligible during the testing period. Now, what is the testing period? It begins on the last month of your tax year, December 1st, right, as we go over it, to December 31st of the following year. See, the year changed, 2018. That's not a mistake. Right? It ends during the after the 12-month period. If you fail that testing period and you're no longer eligible for the following year, the contributions you've made are no longer tax deductible, and you will be subject to a 10% tax on the contributions after the date you become ineligible. So if on July, using this example, if on July 10th of 2018, you're no longer eligible, then you fail the testing period. Every contribution you make following that July 10th period will become taxable retroactively. Additional contributions. You get to make additional contributions if you're 55 years or older at the end of the tax year, right? So whatever the limit is for that particular year of contributions, you can add $1,000 more to that plan. If you make over the amount of contributions you're allowed for the tax year, you will be taxed 10% on the excess of the contributions you make over the limit. There are reductions to the contributions limits for each year. If you made contributions to an Archer MSA, you must reduce in that tax year whatever amount you made to the MSA you must reduce how much you can contribute to your HSA. This includes if your employer makes contributions to your MSA, you must also reduce how much you can contribute to your HSA. Married people, this is special rules for married people. Again, if your spouse has a family high deductible healthcare plan, both spouses are treated as having the family version of the high deductible plan. And those family limits would go into effect. Even if you're signed up for an individual plan at your particular job. You have to be cognitive of that. If each spouse has family coverage under a separate plan, the contribution limit will be the family limit. If both spouses are not enrolled, this is a Medicare when you're older, right? If both spouses are not enrolled in Medicare at age 55, then you may increase the limit by $1,000 for each spouse. You get it? So you're in the family plan. Both married people are over age 55. Neither one of you are on Medicare. You don't get a $1,000 bump up. You get a $2,000 bump up. $1,000 for each person. If only one person is over 55, then only one can increase contributions under the family plan. Employer contributions. You must reduce the amount you contribute to your HSA by the amount your employer contributes. Even if they contribute through a cafeteria plan, you have to be paying attention, right? You cannot go over the limit per year of the maximum contribution. That maximum contribution was the first slide we went over, right? It was listed at the top. Now that changes every year, but you cannot go over that in aggregate, in total. That's the most you can put in there from any source. If you go on to Medicare, the first month you're enrolled in Medicare, your contribution limit becomes 0, right? You can contribute right up to the month that you are enrolled in Medicare. At that point, you can no longer contribute any money. Funding. You can fund your HSA by rolling over IRA money. Why would you do this? Well, let's say you have a lot of money in your IRA because you're older, and this HSA just came out. You have some medical bills that you want to pay for using monies that you have in an IRA. To make it easier, you can roll over that money from your IRA. Now it's going to be a traditional IRA or a Roth IRA. Right? It cannot be done through a SEP or a simple plan. A self-employed. SEP is a self-employed plan. Right? And there can be no employer contributions made in the tax year to that retirement plan. Right? The SEP or simple has to be out of commission. Like no more employer contributions go to it. So if you're still working and you still have that SEP plan and the simple plan, and your employer is still contributing to it, you cannot roll over those funds into your health savings account plan. Because if you want to think about it, your HSA is almost identical to an IRA or a retirement plan. It's merely a savings account It's just used for health care purposes only. Right? So here's how it works. You're going to transfer the funds from an IRA or a non-ongoing SEP or simple plan, and they must be transferred directly. From one trustee to another. All right? You can only make one of these transactions in your lifetime, unless, let's go to C. You make under one, you make one under, so it would be you have two plans going on, right? You have a self HSA, and then later in that year, you switch to a family HSA. So at that point, you can then switch, because what would you'd be able to contribute to that one self plan, and then you'd have another ability to switch into to transfer money into a family plan as well. And it's got to be in a different month in the same exact tax year. Again, testing period rules apply. Rollovers. You can roll over one HSA to another. So, if you're going to roll, let's go back to to transferring from a Roth or an IRA or a separate simple. These need to be direct rollovers. You cannot take the money out of your IRA as a check or as a deposit into a regular bank account and then contribute it to your HSA. It has to be directly from one account, like your IRA, directly to your HSA. If you have two HSAs, you are allowed to roll over like you would normally roll over a SEP plan or a simple plan or a 401k into a traditional IRA, which means you can take the funds as a distribution, and then you have 60 days to roll them over into your new HSA. You can roll over any Archer MSA amounts, but Archer MSAs are older plans. You can roll over any of these MSA amounts or any other HSA amounts to your new HSA plan. Again, you can only do one of these rollovers per year. So this funding with your IRA is once in a lifetime, except for this rule, where you have a family plan that a single plan that switches to a family plan. But in a rollover situation where you're rolling one health savings account to another or an MSA to another health, MSA stands for medical savings account, to an MSA, you can do one a year. Minimum deductible and maximum deductible. This is what is going to qualify your health insurance as a high deductible health insurance plan. What is the minimum annual deductible to be considered an HSA? Well, to be considered to be able to put money into an HSA. A self plan only. And now I don't use that term. That's the term that the IRS actually uses. I'd call that an individual plan, but we'll call it self plan because that's what the IRS uses. The self plan, $1,350. Family plan, $2,700. That's the minimum amount your deductible can be. What's the maximum annual out-of-pocket expense? And yes, this is crazy because if the deductible is too high, then it also doesn't qualify for an HSA. So you have to watch and make sure. Health insurance companies are going to comply with these rules. I haven't researched it, but I'm assuming there are plans with even higher deductible amounts that wouldn't qualify you. But the maximum amount out of pocket for 2019 for the self plan is $6,750, and for the family plan it's $13,500. So here's what would happen. You would pay for the first, let's go with the max, because most I've ever seen is going to be the max plan. The most, what I would say is, the first $6,750 for that year of medical expenses, you're going to pay yourself. You can either pay that deductible out of your HSA, or you can pay that out of pocket. Okay? Now, again, these limits are in network only. Once you're out of network, there's no limits, right? Out of network, it's whatever your plan says. But in network, they have to abide by these annual max limits. So you're responsible for that initial amount. Anything after that is going to be picked up 100% by the insurance part of that product. So again, it's a two-tiered product. You have an insurance aspect, which is going to be significantly lower than your regular insurance. Because you're going to pay the first $6,750, right, which is going to significantly lower the insurance risk. So what you're essentially signing up for is catastrophic coverage. Get rid of that. Next. Excess contributions, back to those. There are another few rules. So you must report excess contributions as other income adjustments on your tax return. You must pay a 6% excise tax. That is in addition to that 10% income tax penalty, right? So you have your 6% excise tax. And what does this mean? You pay an excess tax on 6%. So whatever you've gone over the limit, you're going to pay 6%. That excise tax applies to every single year that extra money sits in that account, as well as the interest and gains that money accumulates. I have no idea how the IRS is going to calculate this. I've never seen it done. I'm assuming this is more of a we'll find a way to punish you later type of thing. But the excess tax, again, applies to each and every year. The excess contribution remains in that account. You can avoid the excess penalty if you withdraw the extra money by April 15th. You also must withdraw the income from that excess contribution or any growth in the investments to avoid that 6% each and every year after that contribution year. Distributions. They're always tax-free up to the amount of your qualified medical expenses. Your distributions over medical expense limits will be taxed at ordinary income tax levels. So this is a different income tax, right? Distributions you take above and beyond whatever your medical expenses are, that are qualified medical expenses, are going to be taxed at your ordinary tax rate, right? It's as if you took a distribution for nothing. In addition, you will be taxed an additional 20% on top of your normal income tax rate. So that penalty is pretty high. What are qualified medical expenses? They are any medical expenses that would qualify for medical expense deductions as an itemized deduction under Publication 502. That covers the gambit. Now, I'm going to make a special video just on those expenses when I do the videos on the itemized deductions for medical expenses. Be sure to watch that so you can get a better idea of what is covered and what isn't covered. Here's a good idea, though. Medical expenses that are going to be covered are typically going to be anything suggested by your physician, right? Anything medically necessary. What counts as medically necessary? We can even go as far as you become handicapped. You need a wheelchair. You need to increase the width of all the door frames in your house. You need to put in special handicapped access ramps and lower the counters. right? All that counts as a medical expense because it's medically necessary. All that stuff would qualify. What else is going to qualify normally? Things that you wouldn't think. Any prescription, obviously going to be covered. Over-the-counter medicine, covered as long as your doctor writes you a prescription. So here's the gimmick. If you want to use this policy a lot, make sure you get friendly with your doctor. Have them write you prescriptions for Tylenol or whatever you need. And when they do that, you keep their prescription. You get to write off and you get to distribute the money for over-the-counter medicines prescribed by the doctor. Obviously, insulin if you're a diabetic. Who's covered? Right? The policies cover your spouse, you, and all of the dependents you claim on your tax return, as well as any person you could have claimed on your tax return, except for the fact that they filed a joint return, had gross income of $4,050 or more. You or your spouse, if filing jointly, could be claimed as a dependent on someone else's 2017 return. That's complex. If you need further clarification, call a CPA. If you take distributions, there are some things you cannot do. So if you take distributions from this, there are certain things you cannot use that money for. Right? You cannot take, on your tax return, your health coverage tax credit for premiums paid. Now, if you want this changed, write your congressman. I believe you should, right? You were responsible enough to put so much money into this healthcare plan. You were responsible enough and lucky enough to not get sick so that you could build up this plan to a sizable amount. You should be able to take distributions from that plan and use it to pay off your health insurance. You can't do that, right? But you also can't take credit for premiums paid. What you can't do as well as you cannot treat your insurance premiums as qualified medical expenses. So normally, let's go back and I'll show you. Under this publication 502 and medical expenses, your insurance premiums qualify as a medical expense. As an exception, your distributions from your HSA don't count, right? Unless you're paying for with your HSA account long-term care insurance, health care for COBRA, healthcare coverage while receiving unemployment. So again, when you're unemployed, you can use your distributions to keep you covered by health insurance. This is critical because the number one thing you lose when you become unemployed is usually your health insurance. This is why this can be so valuable. That as well as you can get this plan up to $1 million by the time you retire. Right? You could fly off to Panama, get yourself the latest stem cell injections, stay young forever, or whatever the thing is, and all that's going to be covered. Medicare and other healthcare coverage if you're 65 or older. Right? So, if you're on Medicare, you can cover those premiums. For Medicare, what you cannot cover are premiums for Medicare supplements, such as Medigap. Oh, I'm sorry. I misspoke. You can pay for other premiums, so that when it says other healthcare coverage, other premiums would include Medicare supplements like Medigap. So again, when you get older and your resources have diminished substantially because you're no longer working and you're relying on retirement and you're relying on Social Security income, this can be a huge supplemental amount for you to use to pay for. I mean, Medicare takes out a huge chunk of your Social Security if you're going to pay for your Medicare through Social Security, as well as any gap insurance, right? That's important. You can continue to pay for your long-term care insurance. This is just, it's such a huge benefit to have when you're retired, because the number one expense you're going to have in retirement, this is documented all over, the number one expense is going to be your healthcare expenses. That's the number one thing that drives the elderly into poverty. You can avoid this by maxing out your health insurance, your I'm forgetting what this is called, your HSA plan, and you can keep as much money for you to use and will benefit you until the day you die. Now, let's go on to that. The day you die. The day you die, one of two things is going to happen. If you have already designated in the HSA plan your spouse as a beneficiary, the HSA plan will stay as an HSA plan and roll over to your spouse tax-free and can continue to be used as such. If you have no beneficiary in the plan, right? Not in your will, but in the plan, you have no designated beneficiary for that HSA. The plan becomes taxable. It is no longer considered an HSA. It will be added to the value of your estate and could possibly push up your estate, again, if you have $1 million in there, to the point at which you have a taxable estate. But, step 3, if your spouse is the beneficiary, none of that happens until their death. And that's it. That's all the info we have on your HSA. Thanks for watching the video. I hope you learned something. Please click the subscribe buttons below. And in addition, there are links taking you to the tax software that we use for most of these tutorials. When you click on the link and you use this tax software, we get credit. When we get credit, we can keep providing you with these free tutorials. So again, if you found these videos helpful, please click on the links, help support us. And in addition, if you were to join myfreecpa.com, you could get these videos without any commercial interruptions, which would help everything move along faster. And you can actually save the videos so that they're there for you year to year as your situations either remain the same or change. And it's just a one solid place for you to find exactly what you need to help you prepare your tax returns every year. So once again, thank you and have a great day. Thank you once again for watching this video. Don't forget to subscribe. Don't forget to click notifications. On My Free CPA on YouTube, you're going to have a link to myfreecpa.com. On here, I would encourage you to sign up, get yourself an account, because you're going to be able to save all the courses I put that are relevant to you. And you're going to be able to go back and reference them year after year after year. In addition, there's going to be a do your own taxes link. This is going to be free online tax software if your income is below a certain threshold. It's basically just like TurboTax or H&R Block online taxes, but cheaper, right? This is the professional software I use, put online for individuals. I'm going to be using this software in most of my videos to explain to you how to do your own taxes. So if you want to sign up for this, please use that link. And when you use that link, I get credit, right? If you're going to do a tax return that's going to cost you some money to prepare using the tax software, because again, not all tax software is free depending on your income levels and your other circumstances, I am going to get some credit and get paid for this so I can keep putting up this videos for you. Thanks once again, and have a great day.